The market plunged, found a floor, and violently snapped upward. Right at the close of the August 13th trading session, buyers stepped in with aggressive late-day defense to rescue the major averages. But that technical recovery is immediately walking into a macroeconomic minefield. Tomorrow morning, this fragile momentum collides directly with critical inflation and consumer data. Before we map out how to navigate this, remember that this analysis is strictly for educational purposes and is not financial advice. To survive the August 14th session, we have to deconstruct that late-day volume, map the sector divergences hiding underneath, and build a reactive trade plan. Navigating high volatility environments requires subordinating micro-level chart excitement to macro-level reality. Trading purely on emotion, single timeframes, or isolated chart patterns during a high-impact news week is a quick way to drain your account. The professional antidote to market noise is a strict top-down trade plan architecture. Step 1 is evaluating the broad index structure to identify the prevailing trend and key support levels. Step 2 requires looking under the hood at market breadth. We need to track actual capital rotation and see which specific sectors are being bought or sold. Step 3 maps the macro catalysts. These are the scheduled data releases that carry enough institutional weight to instantly invalidate our technical setups. Finally, Step 4 takes all that data to build an objective if-then strategic execution matrix. Following this rigid architecture removes personal bias and mentally prepares you to react to binary market outcomes. This S&P 500 one-hour chart details the structural recovery from early August. After a sharp intraday sell-off on the 13th, the final hour shows a violent bullish engulfing recovery. That massive green volume spike at the bottom right indicates institutional-level accumulation defending the lows. We can verify if this accumulation is broad by checking this one-hour chart of the NASDAQ 100. We find the exact same architecture. The tech-heavy index consolidates, dips, and mounts a sharp, high-volume defense of the higher low on the right edge. Moving over to this one-hour chart of the Dow Jones Industrial Average, the pattern confirms again. All three major averages show a unified, high-volume defense against further downside pressure. However, surface-level unity across the major averages often masks severe internal fractures in the market. This S&P 500 heat map lets us look inside the index components. The visual data immediately tells us capital allocation is highly fragmented. Strength is heavily concentrated, showing massive capital rotation into defensive mega-cap technology names like Apple, Microsoft, and Google. That heavy concentration in tech sits in stark contrast to severe, isolated weakness in legacy sectors. Down in the bottom left, Cisco suffered a massive 8.4% drop, highlighting a glaring vulnerability in the communication and networking space. Scanning the middle, industrials and financials display a highly mixed, non-committal array of green and red blocks, proving a lack of broad confidence. One distinct outlier is Tesla, posting a bright green 3.8% gain, showing extreme relative strength. This type of fragmented, highly selective environment creates a dangerous stock picker's market. Buying the broader index blindly carries massive hidden rotational risks. We have to target specific, proven capital flows to survive. A pristine technical setup on a chart is instantly invalidated the moment high-impact macroeconomic data prints. This is the economic calendar for August 14th, outlining the hurdles testing our technical support. At 8:30 a.m. Eastern, we get the core retail sales numbers. Retail sales act as the ultimate directional test for the vulnerable consumer cyclical sector. Then, later in the session at 10, we get the preliminary University of Michigan consumer sentiment and inflation expectations. Those inflation expectations specifically dictate the direction of bond yields for the rest of the day. Bond yield volatility connects directly back to the valuations of the mega-cap tech stocks currently keeping the NASDAQ afloat. If yields spike, tech valuations contract. The technicals built a firm floor on the 13th, but tomorrow's macro data will act as either a launch pad or a sledgehammer. Now we transition from passive analysis to active execution by constructing a dual-sided reactive matrix. Scenario A is the bullish Goldilocks outcome. The trigger for Scenario A occurs if retail sales come in strong enough to stave off recession fears, while the University of Michigan inflation data stays cool. In that environment, the August 13th accumulation converts into a structural index breakout. Our target shifts to the proven relative strength, NASDAQ megacaps and Tesla. Scenario B is the bearish liquidation outcome. The trigger here occurs if retail sales collapse, indicating consumer weakness, or if inflation expectations unexpectedly spike. The consequence is that the August 13th bounce gets aggressively sold, failing those intraday support levels. Our target shifts to shorting the established weakness in Cisco and industrials. Professional traders never predict the news. They map the exact boundaries of their reaction before the print ever hits the tape. With our execution protocol locked in place, we eliminate emotional decision-making. Do not front-run the data. Wait for the initial 8:30 a.m. volatility to print and let the spread settle. Stick to the capital allocation strategy. Target establish relative strength in the bull case and attack relative weakness in the bear case. Finally, fiercely manage your risk and size your positions appropriately for a high-impact news session. By combining index structure, sector breadth, and macro timing, you master the only variable in the market you truly control, your own execution.